All right, great day, Gadfly subscribers. It's Carlos. Today is Monday, March the 16th. And today I'm here with Ken Schortgen Jr. of Shotgun Economics for our end of day market recap. So, Ken, go for it.
Good afternoon, everyone. Today is Monday, March 16th, 2020. And this is Ken Schortgen with the CJ of the Gadfly, and we're here to give you a market wrap-up on one of the most extraordinary days to hit the markets in a while. Now, for those who were able to listen to yesterday's roundtable, shortly after the Fed Chairman Jay Powell came out and they had a secret meeting. You would think it was 2008 and it was the Lehman weekend, the Paulson plan. No, they dropped 1 full percent off the Fed rate. So we are back down to zero. We are now officially at ZERP.
ZERP.
Plus, they decided that they were going to do $700 billion over the next few days. But guess what? That wasn't enough. They had to put in another $500 billion today. And it still didn't matter. Because what we did, as you can see from the equity markets, we nearly hit the second circuit breaker, which is 13%, during the final 5 minutes of trading. The Dow was down at 2,997. At one point in the last 5 minutes, we were below 3,000, closing out at 20,188 and bringing the Dow officially to the point of the inauguration of Donald Trump in 2017. So everything that he had pumped up has now been lost. Meanwhile, the NASDAQ was down nearly 1,000 points, down 970 to 6,904, losing the 7,000 handle. And the S&P 500 was down 324 points to 2,300. So everything not only has lost the 200-day moving average, it is moving back towards about a 50% correction. Now, it's not just the U.S. markets that are falling like dominoes. The Europe 600 stocks ended down 4.9%, the lowest since mid-2013. South Africa's FTSE was down at 12.2%, the most ever in a single day. Muni bonds extend the worst rout since 1987. Copper slammed crude prices, which we're going to take a look at shortly. We're down to the lowest level since 2016. Silver and gold, we're going to touch on that. You are going to be astonished when you take a look at how much the paper price was destroyed today. But with that being said, gas prices are down 21%, which is good for those who need it. Of course, we're supposed to quarantine, so we shouldn't be driving anyway, right? Right. And likewise across Asia and the rest of Europe. Meanwhile, you would think that bonds would see much more action as the money coming out of the equity markets has to go somewhere, but particularly it did not go into treasuries. And this is where we're seeing a disconnect between the treasury, the bond market, and the stock market. The 10-year was down 2 basis points in yield to 0.745. Before the market started, it was in the 0.6 handle. And take a look at the 3-month, 0.216. We are almost to the point that the front end of the bond market is going to soon be negative. Even if the Fed discount window is not negative, we could have U.S. Treasuries, the subprime bond, as Jim Willie says, become negative. Now, NERP arrives. Treasuries trade with a negative yield. Thing about it is even though the yield may be positive, there is a reason why it would actually go negative. With the Fed's cutting rates 3 days ahead of the regular Wednesday FOMC meeting by 100 basis points to 0% to minus 25 basis points, while also announcing a fresh $700 billion QE through their FX swaps with their interest rate swaps. Panic is in the air, as reflected in the S&P futures, which have been locked limit down since the open. That's what ended up happening when the markets opened yesterday for Asia. Instantaneously, futures were down 1,245 points, or 7%, and they remained that way until the open this morning.
Yep.
Now, as BMO's Lynn Lingen wrote in his Fed postmortem, it is not inconceivable we could see negative treasury yields in the front end, as I just pointed out, when Asia comes back online, and that's precisely what happened. Yields on several treasury bonds expiring in the next 3 months were quoted with negative yields. So when you see the bond yields, this is what they are going for right now at the bid rate. But ones that are already owned that are waiting to mature, those have the capability of going negative, and that's what happened. So the U.S. Treasury, the reserve currency, has a negative yield.
Whoa.
End of story.
Wow. Wow, that's crazy.
Moving over to the dollar, well, we spent most of the day in the 98 handle, but when we had the big sell-off or dump in the equities of the last 30 minutes, same thing with the dollar. Dollar was down 79 cents to 97.76. Let's take a look at the 5-day chart, where we have been into the 99 or just below the 99 handle. So in 5 days last week, we went from 94 to 98.5, and now we're back down to 97. So the dollar is getting disconnected from everything as well. It goes back to what I mentioned in the roundtable yesterday. The price discovery mechanism, because of so much intervention, has been destroyed. Nothing is its actual value. Everything is manipulated, artificial. Nothing is real. And when it comes to the dollar, Alhambra had this interesting article that they came out with late last week. Let's see. Dealers ended. Okay, the scale of the things when it comes to the repo was supposed to wow you with all suddenly impatient sellers on the New York Stock Exchange saying, "Ooh, boy, $500 billion." And then we're talking about Thursday and Friday. Besides the 700 billion QE that was initiated yesterday, the 500 billion additional that had to be put out today, there was 500 billion on Friday, 500 billion on Thursday. All of a sudden, repo, which was just to be this overnight thing, has now blown up to $500 billion every single day.
That is just insane.
But here's the problem. Dealers only ended up taking 78.4 billion or 16% of that. Why? Because the repo is based on owning of the treasury, and they've pretty much repoed every single treasury that the primary dealers and the banks have. There's no more assets for them to get liquidity. Oops.
Wow.
So now what are they going to do? This is why when you hear either on CNBC, JP Morgan, whatever, Jay Powell is trying to get banks to go to the Fed discount window. Instead of doing repo, which doesn't charge them interest, he's trying to get them now, come, we're at 0%. You can get free money. Free money!
Everything is awesome.
Everything's awesome. And with the FX swaps, that means foreign banks can come to the Fed discount window and get virtually free money. Welcome to dystopia. Now, take a look at what gold and silver did. Oops. Gold, for the most part, had fallen down to about $14.50. Silver, meanwhile, let's take a look at the silver chart. You're not going to like this at all. Where are we at? Silver price USD. Oops, we went down to $11.40.
Interesting.
Now, this is the paper price. And the reason why I'm saying this, and it's significant, let me go back to
because you can't buy it anywhere.
And the places that you can buy it, this is my local coin shop. This is what they're charging for Canadian maple leafs. $16.78. That means that we've got a $4 and $4 premium. $17.78 for US Silver Eagles. $5 premium. You're not getting that spot price. The disconnect between the silver, the physical price, and the actual paper price has now become what's known as backwardization. And it is a disconnect. And the greater that this disconnects, the greater the premiums are going to be. Plus, when it comes to that, as Bullion Star pointed out about the disconnect, we have the potential for a short squeeze because of real supply and demand. And as mentioned on Friday, the U.S. Mint is out of silver. And dealers like JM Bullion have had on Thursday 300% sale days, with about the same. They didn't have their final report on Friday. So they are selling out. And if you've got a demand this great, you're not lowering the price.
Yeah, there's no need to. I mean, every site I went to today, Ken, was either closed for a certain time for any type of business, and then whenever it did open, the numerous coins were sold completely out.
The key question is going to be, how soon until there is a short squeeze in the derivatives market? Well, guess what? If most of these derivatives, as we see with the price, is because of margin calls to cover all this leverage in derivatives, at a certain point, the COMEX is actually going to default, and it's going to be an official default. And this is the thing that London Paul, Jim Willie, myself have been waiting for. Because once you have the default, then the integrity of the paper markets and paper derivatives markets, i.e. futures or the GLD ETF, they will no longer be valid, and you will see people ditch them about as quickly as we saw Bitcoin go down from 20,000 to about 5,000.
I completely agree. Absolutely.
Okay, speaking of Bitcoin, yes, we lost the 5,000 handle. Bitcoin's down 8% today, and the market cap for all cryptocurrencies as a whole is below $100 billion. I don't know if people remember, but in December of 2017 and into January, when Bitcoin got to 20,000 and it rose, as they say, a rising tide lifts all boats. For all other cryptocurrencies, the market cap was at $869 billion. Now we are back down to just $90 billion. And this is on $1.38 billion worth of trading value or volume for the Bitcoin alone. Normally, the average is about 500 million. And if you remember on Friday, for those who saw the market recap, the volume was at 2.66 billion. So there's a lot of trading going on, but it's not being done by your average mom and popper who's got 0.000156 of a Bitcoin. No, these are by the Wall Street trading firms that are the whales that own the majority of coins. And by their selling, they can move the market very quickly. And especially with this volume, see it drop from $8,000 just 5 days ago, down to the half its value.
Right. How many Ken? How many exchanges do you think will have to shut the doors because they can't pay anybody out because they lost so much on that? That's just insane.
Oh, that's a great question. I think most of them that are around today have learned not to rehypothecate, i.e. trade coins that they don't have. But there's always people who think that they can con the con men.
Bingo.
So we'll have to see. The one, and CoinDesk, Bitfinex, and Kraken, they're regulated up to a point, so they've got some scrutiny. They should be fine. Moving over to oil. Yes, we have lost the $30 handle again. Oil was down 8.19% in West Texas Intermediate, down $2.60, but take a look at Brent crude. A $4 collapse, 11.37%, and we almost have Brent crude not only below the $30 threshold, but almost even with with WTI. This will be a game changer, and it tells you the significance of what is going on in Europe as they start balkanizing, closing their borders, and the ability to sell oil. Say the North Sea from Norway, the North Sea from Britain, their inability to sell oil as most of the countries start locking up their sovereign doors is going to see Brent crude fall at an even greater pace than WTI. Well, one of the things we talked about, and I've mentioned this before, probably over the last 10 years, is for me personally, when the Dodd-Frank was passed in 2010, that had as the second provision allowing for the rehypothecation of your deposits being labeled as liabilities, not as assets to you, that they can go ahead and steal them if they need to recapitalize. And obviously from the credit problems that are going on, where the Fed can't even supply enough money to sustain the banks with all their speculation, how quickly before the banks or the government decide to call a holiday and we start seeing potential bail-ins. Well, it may come sooner than we think, because these are 3 instances around the world of runs on the banks beginning. Midtown Manhattan, bank runs out of $100 bills amid the corona panic. Now, we talked about this yesterday. I think you even brought it up, CJ, late in the day. But individuals who are going to be quarantined are going to be pulling out as much money as cash as they can to go ahead and sustain, because who knows what's going to be closed, what's going to be open, and the banks are probably going to be one of the first to shut their doors. Then we have Austria. Austrian bank jog begins as ATM usage doubles and triples. So people withdrawing cash from ATMs has been up triple the normal average of 200 million euros. Finally, the rich, the wealthy are getting into it. The rich are making runs on the banks in the Hamptons. How'd you like to have that bank balance?
Yeah, exactly, right?
Now, they took out enough so that they fell under the $100 million threshold. But with that being said, even the rich know the game. And as they say, if you want to be wealthy, you do what the rich do. If the rich are getting out of town, just like the Russians did just before the Cyprus bail-in, then keeping your money in the bank is a, let's just say, it has risk involved at this time of the game, because we never know what Congress, in their desperation, or President Trump is going to do to try to keep their political capital, as well as try to show Americans that they're fighting for them against this coronavirus. Well, as I mentioned before, emergency Fed repo fiasco, funding markets remain frozen even after another $500 billion put in. So we're reaching the point where the credit markets are about to seize up completely, and there's no more collateral. Everything has been leveraged so great that, and every asset has been collateralized, that once the credit crisis occurs, there's going to be absolutely nothing, no amount of money that the Fed can do. It has reached a point beyond diminishing returns. And finally, I had mentioned this a little bit earlier, but this is a growing trend, as Canada today decided to close up its doors and not allow any travelers in its borders. The balkanization of Europe is taking place that could bring down the European Union even long after the coronavirus event is done. The lockdown of Italy is not a temporary thing. The suspension of free movement is temporary, but portends something bigger. It's the beginning of the real political balkanization that's coming to the European Union over the next few years. Notice this is just a couple months after Brexit. The final Brexit finale was January 31st. And yet we started seeing this less than a month and a half after Britain finally was able to disconnect from the EU. Old enmities and prejudices have not been stamped out under the boot heel of oppressive legislation from the technocrats in Brussels. They have only been suppressed. For decades, Germany refused to lighten up on its fiscal inflexibility, believing rightly that it shouldn't subsidize places like Italy, Spain, Greece if it didn't want to. Same time, Germany transmitted these rules to the single currency regimen of the euro. That was the price they were forced on to the rest of Europe. Point about this is that as countries in Europe like Italy, Germany, Austria has already done it, and a few others start ending what is considered the hallmark of the EU agreement, the Schortgen Pact, which allows you to travel across borders without a visa. Once this extends for months at a time and the borders are locked, what you're going to do is you're going to discover that the people suddenly realize, hey, we prefer to be our own sovereign country again. We want to keep the foreigners out, and we want to protect ourselves, because here in the midst of the crisis, other countries, including this nice little bureaucracy in Brussels, were not there to help us. So why do we need them? This is going to portend the end, probably the acceleration, or as London Paul said yesterday, the accelerant to seeing the end of the European Union. Anyway, that's all I have today for this market wrap up for Monday, March 16th, 2020. Anything left on your docket, CJ, you want to talk about?
No, just very interesting times indeed. And with the mass injection or the attempt of the Fed to change the course of what is happening, obviously it probably made things worse than better today, Ken.
Yeah, and just remember, there were two things that were being thrown around right at the open when we were limit down in futures and knew we were going to have the circuit breakers hit within the first 15 minutes of the NYSE opening. The clowns at CNBC were all in unison begging President Trump to close all the markets. Because God forbid, when we were artificially pumping up 11 days in a row of new all-time highs, God forbid we have a sell-off, and so we're not allowed to see the markets move in the wrong direction. The other thing is Andrew Yang has been a voice for the Democratic progressives of giving cash to the American people, helicopter money. Well, now we have a so-called Republican who today in an interview advocated giving each American taxpayer $1,000 a month for the next several months. And that individual was Mitt Romney. So flip-flopping Mitt, you can never tell if he's a Republican, a Democrat, or just a big fake job, has now decided that he wants to channel the ghost of Andrew Yang and bring about free money for the masses.
Yep, absolutely. Ken, thank you so much for an awesome market recap. And we did put this out on public platform today for people to tune in, because I think it's just so important to get your information regarding the financials, regarding the markets from a valuable source. And Ken, again, Ken at Schortgen Economics does a fabulous job of breaking down nearly every day. And if it's not every day, it's because we have a roundtable to discuss a lot of the economic measurements and things that are occurring. So again, for those tuning in for the first time and hearing Ken and learning about his work, also venture over to the gadfly.bhx.tv, where you can learn about our subscription-based system, which is a 7-day free trial. You can also then either choose $10 a month or $100 a year, because it's just so important right now, again, to get your information in regards to the markets, the geopolitical landscape from contributors like Ken and also Jim Willie and London Paul. So Ken, thank you once again for a great market recap.
Thanks, CJ, and everybody. Guess what? We get to do it again in about an hour when Asian markets open.
Looking forward to it.